U.S. consumer prices rose less than expected in February, bringing relief to investors. The CPI increased by just 0.2% last month, down from January's 0.5% rise, with the
This
annual
is
rate slowing to
encouraging news that we got
2.8%.
today, and tomorrow's PPI report should probably go along with that to indicate that maybe we have renewed a downward track for inflation.
CFRA's chief strategist Sam Stovall calls it encouraging news, suggesting inflation may be back on a downward track.
Looking at today's CPI report, I think investors are breathing a sigh of relief as it relates, first off, to the consumer price index, since all four measures posted better than expected results. Also, the PPI report that should be coming out will also likely offer four levels of improvement, month over month, year over year, as well as for the headline and the core readings. And that will go a long way to encouraging investors toward the PCE report that will be released at the end of this month. Well, Fed Chair Powell recently said that the expectations for inflation are that they should remain fairly sticky and be challenging to combat, and that it might take until 2026 before the year-over-year core CPI ends up coming in around 2%, their target. So expectations from the Fed are still relatively elevated. Recession doesn't necessarily be affected by inflation. Stagflation is something that investors have been worried about, indicating that growth might slow, but inflation would stay sticky. This report, I think, goes a long way to ruling out the possibility of stagflation. However, recession is another matter. Right now, I believe we are in a manufactured stock market correction, meaning that because of the trade disputes, that is causing pressure on the stock market. But take away this trade dispute pressure, and the market will likely buoy as if it were a balloon held underwater. So I think we still have to wait and see about the strength of the economy. Our expectation is that it'll still remain above 2% growth for both 2025 and 2026. While I still believe that the stock market has more digesting to do, we'll probably experience a counter trend rally and then possibly go and retest the recent lows before working its way higher. I still think that we're likely to see a high single-digit price appreciation for all of 2025, as we find that earnings growth is likely to remain near 10% for the full year. I am cautiously optimistic, or I am a bull, but with a lowercase b. So I do believe that once we get out of this weak patch, the market will probably work its way higher by year end. Not surprisingly, investors are worried because they are responding to the direction of the market. Yet I think you have to look longer term at inflationary expectations, GDP growth prospects, and corporate profit estimates, and all of them we see advancing in the months ahead. Our expectation for the U.S. economy in 2025 is a little softer than when we started the year. Our expectation for 2024, which has yet to fully be reported, is a gain of 2.8% on a real GDP basis. We had been projecting a 2.5% rise in 2025, but now that has been reduced to 2.2%. So we still believe that growth will be above 2%, but now below what our earlier expectation had been. We think, however, that 2026 will pick up a little bit of that 2025 weakness, and we elevated our target from 2.1% to 2.3%. So what we don't get this year, we expect to receive from economic growth in 2026. I do think that the trade war right now, because it is so uncertain, and it essentially is being driven by one individual, and we don't really know what his overall goal is, that is injecting an awful lot of uncertainty, which, because the stock market remains very expensive, in my opinion, right now the price to earnings ratio on forward estimates is still hovering 2 standard deviations above the mean over the last 20 years, that would imply that investors are probably still going to try to take some profits in those areas where they still have them.
However, uncertainty remains as analysts await the PPI report and assess the impact of trade tensions. With Federal Reserve expectations shifting, what's next for the U.S. economy? Stay tuned for more updates.